It's been over 110 days since we last saw this happen, but what is it and how does it affect us as traders and investors? Also, why are CTAs dropping their positions at a faster rate than they have done in weeks? And is this perfectly normal in a market correction or a market crash? Today, we take a look at the bonds and why they're starting to freak out, higher for longer yields as the Federal Reserve has no idea what it's doing, the free fall of Tesla, and of course, everything about stocks, commodities, and cryptos right now, including why central banks are starting to make a big switch behind closed doors. Let's get into it. This will be a good one. Well, welcome back everyone to The Daily Show. My name's Tom, and as always, we'll be covering the macro, the data, the biggest lead indicators, and of course the hottest charts and why they matter to all of us as traders and investors. If it's your first time here, then remember to subscribe and smash that like button as we all go through how to educate ourselves better on why the markets do things and what to ignore and what to look at. Let's get started with the 110-day rule because it's been a while since we've just seen the 50-day moving average get taken out. And 110 days is pretty rare, and it's actually the 10th highest on record since the 1950s. So what does this mean? Does it mean we're going into a crash? Are the bears going to take control of this market? Or are the bulls still in control? Well, I think it comes back to the 110 days. That's a pretty strong move, and it shows you that somebody truly was buying the market and they were pretty excited about it. So over the next 3 months, we actually expect the bulls to be in control of this market. But over the next 1 month, we expect volatility to continue to rise. And that could give some decent opportunities for investors and traders to get better prices. Now, we've been talking a lot about 20-week moving averages. These levels here are something that usually happens in a market pullback. But what about a 50-week moving average as well? Is that something that's possible? We'll go through it on the charts when we look at the S&P 500. But note here, when we've got all of these green kind of diamonds, that there are decent corrective paths that occur quite a lot of these periods. In almost all of them, though, we end up going through an overall bullish run from that point in time. And you'll notice the most notable ones, which are all the most recent reads, end up leading into further strength. The one notably from the GFC lows, and of course the ones coming out here during the late cycle period. And this area here is, I think, kind of where we are right now. We're in the second late cycle period or middle cycle period of an overall bull run. We've got a chart to really demonstrate that later in today's video if it's your first time here. Let's talk about also whether this day was pretty bad. Well, the number of 20-day new lows was pretty high. The number of 20-day new highs was questionable at best with only one, and 79% of stocks were actually down for the S&P 500 over that session. Does that matter? Well, here are the levels that do matter. Make sure to follow us on X, links in the description down below, because I've added in some new 0DTE data that we'll be going through very, very soon, including the 50-35 and of course the bull level number 2, which sits around the 20 weekly moving average. Let's go into why, though, this market is falling, and more importantly, what it could mean for us in terms of trying to find bottom picks in these zones. So do we have the percentage of S&P 500 stocks really negative? Well, the number of stocks below their 200-day average is actually, and 50-day average is actually not very high. In fact, it's pretty low right now. Now, if you ever get into these 70 reads as a dollar cost average trader, this is a pretty good zone and generally to be looking at markets. But what has been rising up is the percentage of S&P 500 stocks above their 200-day moving average, but below the 50-day. And you'll notice over here, the yellow line is starting to get quite a lot higher. As it goes through, as it goes up, you'll be looking for key levels on the market to potentially start to see structure build. And if we see somebody doing some large transactions, CTAs start to pick it up. We also see dark pool transactions, which we track here, move up. This will be a very, very key point for, of course, bulls to get back into this market. What about the underlying breadth, though? Is that actually improving or not? Well, the answer is pretty much no. You can see here that the percentage of 1 month lows throughout the S&P 500 large caps is actually on the rise. More notably, the percentage of 3 month lows on the small caps is on the rise as well. 18.5% of small caps are down below their 3 month lows. And it shows us that we are in basically a risk-off environment right now, and that we're also in higher for longer interest rates kind of environment. If that changes and interest rates start dropping across the board due to bad earnings or something, that could actually be a bit of a catalyst for the smaller caps. because they are very susceptible to interest rates themselves. Let's now jump into whether the percentage of S&P 500 stocks at 1 month lows is going up, and you'll notice that all of them are going up across the board. Most notably actually from the 500 stocks, which are now sitting at 47. And this is again telling us that it's a sell-off across the board. Most markets are starting to weaken, and the percentage of S&P 500 stocks above their 50-day moving average is moving into the 34 projectile. Now, generally around this area here, between kind of 15 and 25, is where I think a lot of dollar cost averages are starting to look very healthily at the market. And if that just so happens to line up with a couple of key weekly moving averages, it could be a pretty good level. And we'll go through that in a moment. So let's then continue on with this market. Risk on, risk off. Where are we? Small timeframes? No doubt that short timeframes are seeing a huge level of risk off. You can see here risk off metrics, intermediate time frame is risk off, but the longer time frame remains risk on. And this will be important because if we end up getting a flash sell and we continue risk on, then we hit into something like a 4,700, 4,800 level, we see a structure build. This will be a key zone. So the question that everyone always asks when markets start to correct is which area is best to be in? Now, for a lot of people, that's going to be AI. High gamma stocks, they tend to be one of the best. And of course, semiconductors is where most people will be looking. But what about the equal weighted market? Something that's a little bit underestimated sometimes. It's been selling off recently, but if you actually look at it over history, it's actually done better than the cap weighted S&P 500. Now, in the rise of the Mag 7, cap weight has been everything. But equal weight could come through if breadth starts to improve, we make new all-time highs, and we continue down this bull market cycle. So I think it's something that maybe a few people have been underestimating, and I thought that was a really interesting chart for us all to discuss together. Another couple of charts that are big here is going to be what's going on with high yield bonds. We talked about how a movement underneath that 77, 76 would bring out the sellers. And so far, they've been pushing high yield bonds down. Now, that means that the bonds market is kind of signaling risk off for now. And if high yield bonds start to improve, that's usually a pretty good sign that the markets are turning on the bottom end. So if that happens with the 20 weekly moving average or a 50 weekly moving average in the future, it will be usually a pretty good point where markets are starting to say, well, you know what? The investors could be back. For now, though, do we expect worse or better moving forward? Well, one thing's for sure, when you overlay with a 0.93 ratio cutoff of other periods in time where we've run like we've done right now, we tend to be in for some turmoil, up, down, and all around, with an eventual gain in most scenarios. Now, I don't think we're in this 1970s scenario. In fact, I think we're probably more correlated in some ways to 2012 and 1976, which you'll see later on a chart. And in both of those cases, we went back into what we call a correction or a pullback in time, followed by quite strong gains. It's all going to be predicated, though, on this earnings season. So really stay tuned to the channel because there's going to be so many opportunities for all of us as traders and investors as we see some boom and some bust up hard, causing capitulation trades to become one of the best things, I believe, in the next quarter. So what about the oversold, overbought metrics? Well, we just went from an overbought metric on the S&P 500 percentage of stocks above the 50-day moving average to pretty much an oversold metric straight away. Is this a great point to generally buy in? Well, what you'll notice is that this happens quite a few times during corrective periods, and it can signify a bit of an oversold market where we get bounces. So that's why I'm saying around this level here between the 5,000 and the 4,980 may actually bring some buyers. And one of the reasons is because it's been sold aggressively towards the downside. Most markets do this in a normal correction, and then they move like that. Now, this is one of the first signs that we're getting a little bit heavily sold right into the earnings season kickoffs with Netflix coming out on Thursday. Let's jump into the charts. Let's have a look at the S&P 500. What's going on here, guys? Well, first up, we get a long leg doji. We get a high, we get a low, we get an open, and we get a close. Now, the bears did win the session, and there's no doubt that the bears were in control of the session with the way they traded. But really what this tells us is the markets were at equilibrium. They were at a fair point, and they're still overall in the short-term downtrend. Where's the next level possibly for the markets? You'll notice there's a gap fill right at that 49.80 zone. And this week is also OPEX, so there's a lot of options at stake. What I like to always do is have a look at the smaller timeframes as you want to understand the structure of how the market traded during the overall day. And again, if you look at the structure, it was up, down, up, down, up, down, up, down, and pretty much just sitting around the same zone. So it wasn't really, I would say, a huge win for necessarily the bulls or the bears. It was more of a consolidation after getting that heavy sell-off in the previous session. And do remember, pullbacks to things like the 61.8 and 75 fib have been something where we've seen every time over the last 4 times bears recontrol the markets. So where are those levels? Well, let's have a look at the futures market to better understand it. And you'll notice I've outlined here the 51.20 zone as the 61.8, and of course the most traded zone on the way down so far being 51.50. If a bear is going to recommit to a bull run, this is going to be, you would think, where it's at. And because we're still in a negative gamma situation, if markets do push through levels such as 50.35 over the next 24 hours, they hold it down, that could create further hedging by the end of the day, pushing us into zones such as the 49.80. It is very, very possible to do so. What about the smaller timeframes though? Let's have a look at the structure of the futures market, because of course, it's not just the main market you want to be looking at, you also want to look at the futures. This looks like it could be an accumulation or it could be a distribution. It's clear that the market's coiling, ready for the next big move. If it breaks to the upside, it's probably going to push this narrative. If it breaks to the downside, you'd have to think it pushes this narrative. So it's clear that vol should be spiking over the next couple of sessions leading into Netflix, but it's trapped right now. Could it be trapped all of Wednesday? Well, in some ways, the markets are kind of signifying that we're trapped between those zones. Notice here the 50.35 for the Wednesday in terms of the 0 DTEs. A huge amount of puts sitting around here, acting as a put wall for now, or a buying pressure level. But if markets fall through, that's why we're thinking 49.80. And then when we go over to the next session, which is the Thursday, it becomes 51.50. So really anywhere in here is where the market's kind of trapped at this point, with the OPEX expiration, the biggest amount of options right now, sitting at 5K on Friday. So really this is where the trillions of dollars are at stake. So if the market does fall under 49.80, 5,000, you would have to think there's a buyer sitting there trying to defend this zone so they don't need to pay out those options. Now, it's not always the way it works, but if you see a technical level with options, as you're probably starting to figure out, that gives us extra validity and, of course, extra strength in the markets. Here's another way of expiration or looking at expiration for the OPEX. And you'll notice here that we have April the 16th with some big moves on the left-hand side in terms of the amount of puts that are sitting there. And in terms of the buys and the sells, there's overall a pretty decent overall negative gamma kind of exposure sitting around that 5K zone. So between 5,000 and 5,100 seems to be the trapped level for the week. And that's leading into the Friday trade. So up, down, and all around with a lot of day trades and scalps could be very, very real thing. What about CTAs? Are they dumping? The answer is quite simply yes. They continue to sell off in this market. CTAs re-accelerated towards the downside over the last 24 hours. And as promised, we're bringing you this data because look at the S&P 500 one. Wow. The S&P 500 has dropped like a rock. Another huge sell-off of CTAs. And this is perfectly healthy. We needed the CTAs going from max long back down to allow the markets to potentially have a breather where they can start going along again. Notice what happened last year when they got maximum long. They had to sell off for a while, then they rebought in, giving us opportunities to say, okay, well, that probably is a great run for us to get back on the bull side. It also makes sense when we look at things like risk on, risk off sentiment indicators that include all of those kind of sentiment drivers right now, put call ratios and etc., that we were in a risk environment. So basically we need to be kind of getting out of the market, and that now we're starting to drive in to potentially an opportunity market. We'll get an update on this very, very soon, but it's important to know your sentiment and to understand that we were kind of going towards that really overbought type of period. Let's now talk about central bank liquidity, because what happens in the world is we generally see tightening conditions and loosening conditions. Now, since the CPI report last month, the US has actually started to tighten a little bit. But as we saw over the last 24 hours, federal liquidity is starting to loosen again. And the rest of the world, being of course Europe in particular, is actually loosening at a faster pace. So you might think, oh, wow, money's really tight in the world, everything's really tight. Actually, they've been loosening it for quite a long period. And that's led into this market being where it's at. They say one thing, they do the other. Speaking of saying one thing and doing the other, we've been a huge proponent, all of us have, on gold recently. And a lot of people didn't like it about a month ago. Now everybody likes it. And look at these articles being written. JP Morgan says gold has further to run on escalating Middle East conflict. That's one thing, but really it's a currency war, guys. Also, on top of this, gold seen hitting $3,000. Thank you very much, Citi, as investor inflows juice the overall rally. So, yeah, I agree. I think 3,000 is going to be hit, but when you start seeing articles like this, there can be blow-offs in markets. They rally up and they kind of drop off. Although that's the longer-term target over the next 12 to 18 months, the problem is that when everyone's on board, it is not as good. And as I wrote over on X, I said, as Druckenmiller says, it's better to be a pig and understand when the flows are starting, not when they are over halfway through. So this is something that we've been very bullish on now for quite a period of time, along with a lot of the other metals, rare earth minerals and stuff. These things are definitely big storylines in the geopolitical situation that we're going to find ourselves in over the next coming years. But it's all about timing, and timing is everything. In terms of some metals as well, at the moment, there's a good chance they actually might have a pullback in these markets, allowing investors to get back into them at slightly cheaper rates. What about earnings this week? Well, we've got some big earnings still coming, but really most people are just going to be looking at Netflix. After the close on Thursday, and the expectations are pretty wild. A plus minus 9% move for Netflix during the session is going to have a lot of people excited. And I don't think we're just getting started. When we look at the next couple of weeks and we get those Mag 5 stocks in particular starting to report, it's going to be really wild. Huge moves on Mag stocks. That's trillions of dollars of movements, and it's going to be wild in general. S&P 500 election years versus the rest, as we've talked about before, we're kind of following that 12 to 1976 kind of pattern, which involves pullbacks in time or correction paths into generally a bullish run. So I wouldn't be too terrified yet of this market unless earnings don't live up to expectations and they come in really poorly. Remember, most people are looking specifically at the MAG stocks to do very well. It's not going to be the other stocks that are being looked at, just the MAG stocks. S&P 500 secular bull runs. How do we generally see the markets? Well, you'll notice here that secular bull runs tend to go a little bit further. In previous periods, we've actually had incredible runs through the back end half, and you kind of get that feeling that that's the type of way that the market is, with the Federal Reserve coming out every single time the market ever drops even a little bit and injecting some liquidity back in. When we overlay a couple of these, you'll notice that it is pretty normal for us to have some kind of correction path from here to then run bullish and then to end up being even more bullish over the next couple of years. And I've said this maybe back in 2021, that I really don't expect the market to go into a full-fledged crash, that is an epic crash, before at least probably 2026 to 2027. Now, am I still sticking to those dates? Well, we'll have to see how the market ends up playing out. But if you follow the channel, if you subscribe, there'll be a couple of years where I think you'll get some pretty stellar returns, and then it'll get ballistic. And when that happens, we'll be talking about it. What about indicators with annualized returns? I'm just going to throw this one back in there because gold obviously has done something pretty rare. And while everyone's on the bull train, you do need to realize that over the next year, the annualized returns for gold are generally quite positive, with 17.1% being the general expectation when we're above an RSI like this. You might think, it's overbought. Not really when you're looking over the next 12 months. I think it's just getting started still for gold. What about the overall flow? Semiconductors were the best over the last 24 hours, probably in anticipation as well of the earnings coming out and starting next week. And then, of course, we've got here overall metals doing very well, another great sector, and quite a lot of defensives holding up, with anything to do with higher yields for longer suffering over the last session. That's now become the last 5 days. The best performing market is down 2%. And guess what it is? Consumer staples. The defensive sector, then semis, then our metals that we've liked, then tech. It's a weird world when you've got semis, tech, and metals with defensives around it being the ones that are holding up the best. And that just shows you that it's a strange market of AI, geopolitical tensions, and then, of course, just generalized weakness across quite a lot of the other areas. What about the VIX? Are we above 20? No. If we're above 20, that means the bears are in control and we could be going into flash kind of sell situations. At this point, being a high VIX definitely means it's better for traders. We also know that when we look at options, the overall options high yield kind of moves, so this is overall the options for bonds, is starting to spike up. Now, when this occurs, we do usually go into corrective periods. So it's perfectly normal. We actually found it a few weeks ago, which gave us that kind of inkling that volatility was going to spike big time. And so far, it kind of has. Then also, if we look at the S&P 500 and central bank liquidity, you'll notice that as we've fallen down, the Federal Reserve has started to juice the market in a couple of its different ways. So they might say it's tightening, it's tightening, it's tightening on the surface. Oh, we're going to wait for, data dependent, whatever else the Jerome Powell says every single time with his flip-flopping each way. But in general, you can see here that whenever the market has been selling off a little bit, they've been juicing it up. They juiced it last time and they're juicing it again. And this tells you that there is an underpinning of this market. It won't be most likely allowed to fall too much unless something becomes toxic and they can't support it. So I think that's important to note. The bears may have a little bit of a run here, but maybe it's only going to be, in the best case, maybe 10%. US yields. So if we have a look at US 10Y, that's up to 4.65. That's pretty high. US 2 is also trading near its highs after Jerome Powell's speech. So it tells you that basically it's not about yields right now, it's about earnings. Risk off, pretty big risk off here from high yield junks. As long as high yield junks are dropping, that means that the market is more towards the bearish side. So of course, keep tracking that. And the US dollar is benefiting from this. Of course, the US dollar is strong in higher yield environment, makes the USD seem more appealing on the world scale, and it is moving towards this major take profit zone. So for now, the bulls are in control, and I wouldn't be necessarily super bearish on the US dollar. First target sitting around 106.50 to 106.80, as we've talked about. And if we manage to get through 107, wow, the dollar might go wild. There's nothing holding it on the left-hand side here. So it could go all the way up to this 110.80 that I've had sitting there just in case for a little period. Copper still holding its own. Wouldn't be probably entering copper here, but it is holding up. And of course, that's one of the main metals that's experiencing pretty good gains. And if you've been gold bullish over the last 24 hours, we talked about this little level here in the stream that I did for our private community yesterday. And I think we might have talked about it on the daily show here on YouTube as well. It's a decent little buy zone for the markets. We managed to see them hold our trend line. So that's the holds here. And then if they do manage to push through, then we're looking, all-time highs. So watch the 2400. If it does end up pushing through to a new high point, could be going to a new all-time high. And gold's still bullish, although I am cautious on adding to, investment levels here. And the main reason is because when you look at like the higher time frames, it's kind of at an exhaustion period. Doesn't mean it has to stop, still making a series of higher highs and higher lows. But if that changes and we go underneath the trend line again, I wouldn't be too bullish on it for a little period here for gold. Silver still overall the better stack, you would think, over the next 6 months until we get to the 0.013 ratio. Always do your ratio trades, guys. Silver is underperforming gold, although it has actually been a better percentage this year than gold. It's still underperforming. What about US oil? So everyone thought this one would go super long, and it continues to underperform this week. Now, we've been very bullish on oil, but notice that it keeps kind of failing its rallies. So here is where I would have been long in the last 24 hours. Now, that's a pretty good level. It's actually quite replicable. And we did see that pick up there initially. So someone tried to buy. It needs to defend this level. And the more it comes down and tests here, the more you've got to get questioning what's going on. We've already wiped all of these previous stop losses. We found buyers. Really, it should be going from here. So I think if you want to add to new oil positions, you kind of need it to go through 86 a barrel. Here is really the last resort. So oil bulls need to hold this level. Otherwise, next stop, 83 for the barrel for oil. Tesla, we reported on it yesterday. We absolutely hated that chart, and it opened up with a closed low. I'd imprint that one in your mind if you're able to. That was a very horrible close. As soon as you saw a close like that, the chance of it opening lower was very, very high. It didn't quite make it down to the 152.42 level, but as I've said here, watch reaction here. Bulls, I feel like you need to get it down to this level before you end up being too bullish on it. So key zones here for Tesla. Middle ground, not at the low, in the middle of nowhere. There's almost nothing really holding it up here, so just be careful about how that's price action trading. For NVIDIA bulls, they would have liked the 61.8. If you did buy it, it wasn't too bad a day trade, I guess. At least it went up. But to get more excited, you're going to need this thing above 910. Hasn't done that yet. To be more of a dollar cost average kind of investor, you'd love to see that 800 or the 670. 830 is still the most defended put level. So really, if the OPEX expires, the market starts to sell off and it gets through here, I wouldn't be surprised if 830 is broken for us to be looking at just under 800 relatively quickly. That would also fill some gaps as well, which would be a nice pullback for NVIDIA. AAPL defends the level again. 168 continues to hold. No sell-off underneath. Doesn't look good on the charts. Frankly, who knows with AAPL? If it breaks below, again, probably a bit of a warning sign that the rest of the market is also getting hurt. Then there's Netflix. It's coiling. It's coiling for a huge move. And that's why the options market has it on a plus minus 9% move. You'll notice here it's a very correlated, very corrective market. It's sitting right where it wants to be, and the news event will be a blockbuster on that. So keep watching Netflix. Small caps didn't do too badly. Also, Aussie 200 defended its zone. You'll notice here at the time of trade, it's finding that buying pressure around 7,600. This has been one of the most traded levels throughout the last couple of months. So I could see the Aussie 200 doing something like this at this stage. And then hopefully it ends up rebounding. I'm actually quite bullish on the Aussie market over the next 6 to 12 months or even 24 months. You can see volume is starting to pick up very heavily as well. But price action will still be dictated to by the American market. German DAX hits the first level, 38.2 fib hit over the last 24 hours. Hideous candle, again, similar to Tesla, that ended up selling to the main first level. If the DAX can't hold here, where do we go next? Well, 17,250. Again, that would be the bigger corrective path. So 17,250 would be a pretty sweet level for the DAX. And it's been weakening for a while, led by really those banks. Chinese markets continue to struggle a little bit here. You'll notice that they're kind of halfway through, and we'll keep reporting on those. Downward descending channel, 10 cents still holding up, which is probably my favorite single stock over there. And the HSI also suffering a bit. But still, I think that maybe we've seen the bottom in China for now, and we'll keep going to the price action on that. Small caps, not too strong. You'll notice here that they kind of just barely rebounded through some of those levels. If we go back to the weekly, on the last 24 hours, we talked about the idea that we'd get down to maybe 1945, 1944. We didn't quite get there, but I'm not seeing enough strength in the structure yet. Notice that it hasn't even been able to make it above 1978. So really what I would prefer to see here is something like this, and then that to give us a signal towards the buy end on the Russell for the day traders and the investors. That's not happening at this stage. NASDAQ went underneath 17,000 and 780. It managed to get back up to close to that period. You'll see the long leg doji. I do think this is less the trade and more the S&P 500 needs to be watched. So if the S&P 500 can hold this zone, then of course the NASDAQ will try to move towards the most traded level, which sits around 18,100. And that could be where the bears sit for the next move down. Or we go straight down into the 17,450 zone, which will also be the 20 weekly moving average on the S&P 500, the 4985K. That is a very, very important zone for these markets. Ethereum and Bitcoin, they're getting so close to being worked, but not quite yet. So Bitcoin defends the zone we've spoken about so many times. We always say bulls need to hold the 63K zone. Look at the daily. Just barely. Now, this is a good sign. 1, 2, 3, 4 wicks. So you know that someone's buying here. If the market closed underneath there, you can really see why it could be a capitulation sell. This is where the defended market is right now. They're defending that 63 zone as much as possible. And as we've been talking about, this is a very important level for Bitcoin. Because we've been making a series of lower lows and lower highs, you really want to be making it past that lower high to really signify that there's further strength in this market. So I'll just move this down, and that would sit around 66,880. So yeah, Bitcoin's barely holding on. There are a lot of wicks here. I could see why, some people would be liking this area. But if it doesn't hold and it gets underneath 60,000, there's really nothing there all the way down to the next zone. Just in terms of what's going on from the news ahead, it's probably a little bit lighter now in terms of news. It's all about earnings. So really focus in on Netflix later on this week. Follow us along as we go through the Netflix earnings. And remember to subscribe if you enjoy the videos. Thanks so much for watching, guys. Comment down below with your favorite stock right now that you're looking at, and maybe we'll feature it in one of the next upcoming ones. Bye for now. Have a great day.